Signs of strength in Q4, output increase at more than 2.5% on an annualized basis. Let's get more from Jimmy Jean, economist and strategist at Desjardins. Jimmy, great to see you. So a surprising report, because I think the economists were looking for annualized growth of only 1.7%.
That's right. I think this was a very pleasant surprise in that final quarter of 2024, coming in not only significantly above expectations, but also we had some strong revisions to the third and also the second quarter of 2024 as a bonus, and all that means a better handoff to 2025 than what was being expected. So lots of good news when you looked at the composition of this report. You had a 1% increase in per capita GDP, so ending that long stretch lower than per capita GDP. Lot to like in this report. Again, you look at the capex, the fact that lots of it came from, yes, consumer spending, but you also had business investment contributing to that gain. And when you look at overall domestic demand, 5.6%, which is simply spectacular. So, we're not for the tariff threat. We'd be very cheering that report to a great extent.
I guess that's a case, though, of how did you enjoy the play, Mrs. Lincoln, apart from anything else? But with the tariffs, I mean. Interesting, you note that we at last, after a long drought, got an increase in per capita output.
Absolutely. And what's interesting is that, yes, we have started to see population numbers actually accelerate a little bit. But we have seen still that GDP number coming in much stronger than what is still a pace of population that is expanding. So more and more in 2025, that's where we expect the government's measures to curb immigration to really kick in further. So you're going to see a continuing increases, we think, in per capita GDP, all depending on, of course, on what happens south of the border with the tariffs. But the fact that we start to see it in Q4, and also, again, for the right reasons, to see business investment. We've been lamenting that the level of capital per worker in Canada was deteriorating, and now this was a sign in the right direction. Certainly, there was some one-offs. One-time large increases in things like aircraft shipments and shipments. But still, when you look at, for example, machinery, industrial machinery and equipment investment on a year-over-year basis, if you exclude the pandemic distortions, it was actually the first increase since 2018. So that was very encouraging. Again, this is looking in the rear view mirror. And going forward, what you're going to see, and my concern is that as soon as Q1, just because of that uncertainty, you're going to see a lot of that roll back, unfortunately.
That's, yeah. And sorry, you touched on this, but just a reminder, what is your call for the Bank of Canada on March 12th?
So our call is for the Bank of Canada to be on hold. This report goes in that direction. Certainly, if you just look at the data, and we've had some pretty resilient data as well when it comes to the job market, as well when you look at inflation, excluding the GST effect, you've seen some persistence there. So all would be aligned with the Bank of Canada taking a careful approach in future rate cuts. Now, of course, if we find ourselves, just a few days from now in a 25% tariff world, then it's a completely different calculus where I think the Bank of Canada might feel compelled to continue to ease.
It's fascinating, isn't it? Slower population growth, that was the reason for the per capita output increase. I know there's lots of factors there.
Yeah, well, I think it was both. I mean, we didn't see population decelerate all that much. We started to see it decelerate, but it hasn't been crashing by any stretch of the imagination.
Okay.
I think we're going to see more and more the effects of government measures to curb immigration. Those will kick in more in 2025. It will take time, and in any case, we're not expecting the government to fully achieve its aim to lower the level of Canadian population, which is not something we've seen since World War II, contraction in population. So we take that with a grain of salt. But really, it's the numerator, the fact that GDP growth came in so strong, and that's really good news. It was good news.
Sorry. Residential construction increasing at the fastest pace in more than a year. Does that worry you at all, in the sense that we need houses, I know, but new houses don't really add to economic output? They're not like new high-tech factories, for example.
Right, and I think in this case, it's the effect of the residential real estate transactions that we've seen. The home sale market resales actually pick up quite a bit in the fourth quarter, and that's the effect, of course, of lower interest rates. So in some regions of the country where you have more affordability, you've seen lots of traction from the Bank of Canada cutting rates, just giving that confidence to home buyers in terms of making those key important decisions and really wanting to get it into the housing market before it's too late. So that kind of behavior, and we've seen bidding wars in some areas, like in Quebec, kick in. So I think that it's a reflection of that in those numbers today. But I think you raise an interesting point in that, even if we have a scenario where we have 25% tariffs, the Bank of Canada responds by cutting interest rates more than it would, will that fuel exuberance in the housing market the same way we did see, for example, during the pandemic? It was a recession, but you still had the exuberance in the housing market. So that's going to be an important factor the Bank of Canada will probably keep on its radar.
Jimmy, thank you very much indeed.